You're listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone, from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing and build real wealth.
Hello, I'm Deidre Woolard, an editor at Millionacres, and thank you so much for tuning into the Millionacres Podcast. As I record this in February, we're heading into the heart of tax season, and we want to give you as much information on taxes as possible. One of the things I've learned in covering real estate for decades is that everyone's tax situation is different. So please note that anything you're about to hear does not constitute individual tax advice, and always talk to your individual tax professional. My guest today is Blake Christian, who has specific expertise on opportunity zones. You may have seen him quoted in some Millionacres articles about that subject. He brings over 40 years of experience providing tax consulting and compliance services to a wide variety of clients. He specializes in federal, state, and local tax incentive programs and is a CPA. And he and the HCVT OZ team have been involved in the formation of over 100 qualified opportunity funds and qualified opportunity zone businesses. They've also advised hundreds of other investors and professionals regarding the complexities of formation, operation, testing, and restructuring of both QOFs and QOZBs. Well, Blake, thank you so much for joining me today.
Glad to be here.
We've talked a lot about opportunity zones on the show before. The appetite for it from the investors I talk to is really vast, partly because it's still so new and it's been a sort of a long process getting all of the rules in place. Do you find that most of the people that are reaching out to you are looking to build an opportunities fund or find one to invest in?
Most of what we do is form what we call captive opportunity zone funds. And so they're family office, high net worth individuals that are interested in deferring and then ultimately exempting their tax gain. So much more interested in forming their own than looking to place it in a third party's opportunity zone fund.
Interesting. And are they looking to do that for one particular investment, or are they looking to do that to then invest across a couple of different projects in opportunity zones?
It's about 50-50. Half of my clients are either serial developers or serial entrepreneurs with operating businesses. So they kind of have their next 2 or 3 ventures already set up when they have this gain generated. And so the opportunity zone format is perfect for them to defer the taxes and then save taxes. The other half are really a little unclear about what they want to do with the money long term, and are looking for guidance, and put it into the qualified opportunity fund. And they have, in most cases with COVID, up to 55 months to figure out what they're going to do with it.
Well, that's an interesting point, too, is that we keep seeing these extensions happen. At the start of the year, we got another opportunity zone update from the IRS that extended the deadline to invest the capital gains until the end of March. But it also extended the period for a qualified opportunity zone fund or a qualified opportunity zone business to double the basis. So it looks like to me, from what I've seen, that it basically takes out the entire period from April 1st of 2020 to March 31st of 2021. Is that right?
That's correct. So that they essentially froze that period from April 1st through March 31st of 2021. And so the 30-month clock stops ticking during that period. So if somebody already had the project going had set up their QOZB subsidiary by April 1st, they'd have a 12-month extension on that period of time to double their basis.
Okay, that makes sense. Just to clarify for the listeners, what do we mean by basis?
Very good question. So let's say I buy a piece of land with a building already on it. The land has $1 million basis. The building has a $2 million basis. I have to double my basis in the $2 million building. I don't have to count the land. So that's the 30-month period that you have to improve that building or put a secondary building on that property.
Right. So one of the things that we've seen people use opportunity zone funds for is developing a multifamily property on maybe something that wasn't didn't have anything on it before. But I also know that opportunity zone funds can be used for developing a business too. So it's not just real estate, right?
Absolutely right. And about a third of our projects are operating businesses. And actually, I find that those are going to have the most impact. They will create more jobs. They'll be much more sustainable. If you figure, a really, a home run on a real estate project, you more than double your investment over a 10-year period. That's sounds good. It's kind of exciting, but you do an operating business and you could end up getting, 100 multiple on your investment if you have a successful high tech business or, some good idea. So there'll be some very large gains coming out of operating businesses.
Interesting. And in terms of the improvement, can you also use this if you've got an existing building or something like that? You would just have to improve it in order to double that cost basis?
Yeah, it gets a little trickier where you've owned the property before 2018. That asset in your hands is not a qualified opportunity zone project. But you could, as you said, you could make improvements to the building or put another building. You could put a parking lot in there, and those assets would be qualified opportunity assets. And so when you sold it in 10 years, you'd basically bifurcate the sales proceeds into the non-qualified asset, the old building that you had, the legacy building, and then the improvements, that portion of it would be eligible for tax exemption. It's a little trickier that way.
So, in order to clarify for people what opportunity zone projects are, you can take your capital gains and you can invest them into a project within an opportunity zone. How many opportunity zones are there? I've forgotten the exact number.
There's over 8,700 throughout the country. So about 15% of the footprint of the United States is an opportunity zone. So they're pretty plentiful. They're basically uh, allocated out based on population. So California, New York, Florida have the most. Wyoming wouldn't have a whole lot, but they do. Every state has some. And it's also important to point out that U.S. territories, U.S. Virgin Islands, uh, uh, Guam, any territory of the U.S. Also has uh, large tracts of opportunity zones.
And that includes Puerto Rico, right?
Thank you. I was trying to remember Puerto Rico, and about 97% of Puerto Rico. So that there's a whole subgroup of people that work in this area that focus on Puerto Rico because they have some really interesting federal tax laws. They're under the 1954 Internal Revenue Code, and so they have some really unique aspects to their tax structure.
Well, and that's also an area that really needs some help, and that's originally the opportunity zone program was designed to encourage development in these areas, to incentivize developers and business owners to spend their money in these areas to create jobs and things like that. And that's why you have that capital gains deferment. But there's also some interesting things around opportunity zones that I think people find really confusing, which are how long people can defer tax and also what happens in 2026, because I know there's a deadline around that.
Right. No, all good questions, and hopefully I won't add to the confusion. But in its simplest form, let's go back to a qualified capital gain. Both long-term and short-term capital gains are eligible. Also, for you in the real estate world, 1231 assets, which are trade or business assets held for more than 12 months. And so all of those are considered, and also 1250 depreciation. The depreciation on the shell of your building is allowed to be rolled into an opportunity zone fund, but depreciation on personal property, desk, chairs, other equipment, that is not eligible. So you roll the gain into a qualified opportunity fund, and again, you can set up your own or invest in a third party's fund. Generally, the rule is 180 days from the date of sale, but that rarely applies. It can be as many as 170 days. You can still, with the COVID relief, you can go back and amend 2019 returns for some gains and invest those by March 31st, 2021, as you mentioned, and amend your returns and save a lot of money. Once that money goes into the qualified opportunity fund, then as long as you follow the rest of the rules, that gain is deferred until December 31st, 2026. So the gain matures at that point in time. In between, after you've held the fund for 5 years, you get a 10% bump in your basis. So let's say you had $1 million deferred gain, you roll it into the Qualified Opportunity Fund, and after 5 years, you get a $100,000 basis bump. And so when you recognize that gain in 2026, it's $1 million minus the $100,000 basis bump. So you only report $900,000. One caution is we don't know what the capital gain rate is going to be in 2026. So that's one area that people get a little nervous. President Biden has talked about increasing both long-term and short-term capital gain rates for the wealthy, and but still, when you run the numbers out, it's still a compelling investment, even if he takes the rate all the way up. And the tax exemption after 10 years, after you hold that qualified opportunity fund for 10 years, you get a complete federal tax exemption on any post-reinvestment appreciation. So in my example, $1 million rolls in, it ends up being worth $5 million in 10 years. The $4 million gain goes poof. You never pay federal tax on it. You also don't pay state tax in all but 4 states. Those are California, Mississippi, North Carolina, and Massachusetts.
Interesting. I think a lot of people get excited about the capital gains tax deferment, but the part that's always interesting to me is that if you invest in the right project, you get to defer all of the gains from the project, and that seems to be an even bigger incentive.
Right. And again, for your listeners, and 90% of them are in the real estate world, and it really doesn't get much press, but a massive additional benefit under this program. You claim depreciation for 10 years on your project, or 15 or 20 years if you hold it that long. You never recapture that depreciation expense. So you're getting ordinary deductions during the operating period. And then when you sell it, you never recapture that. So it's a permanent savings, and also pops your internal rate of return pretty dramatically on these projects.
That's important because in a normal project, when you sell, you do have to deal with that depreciation recapture, right?
Right. And, I have several very large solar projects. Sometimes they're associated with a building, sometimes they're not. But, when you start talking hundreds of millions of dollars of tax credits and depreciation, which under the bonus depreciation rules you can claim in year one, the economic benefits on some of these projects are pretty astronomical.
So I have a question about the difference between qualified opportunity zone funds and qualified opportunity zone businesses. I know you work with both. What's the difference between the two classifications?
So the way the structure is on virtually every opportunity zone fund is you have the qualified opportunity fund up on top, and that's generally an LLC partnership. And then below that is you would establish a secondary part, in most cases LLC partnership, that'll be 99% owned by the QOF above, and then they'll have a minority owner in the mix. And so that secondary entity, that's referred to technically as a qualified opportunity zone business. But it's a little bit of a misnomer, because that could be a real estate project, but it could also be an operating business. So it's a little confusing, but But that technically it's a qualified opportunity zone business, regardless of whether it's real estate or an operating business.
Thank you. I think that's part of the confusion with the opportunity zones is there's so many acronyms, there's so many rules. I think a lot of people get excited about it and then they get confused. I know another thing that I found confusing is that there are all these rules regarding the qualification process and how often businesses are tested. Can you explain a little bit about how that testing process works?
Right. So in general, you have to test both the QOF, the parent entity, as well as the QOZB every 6 months. And so the basic test, there's more to it, but the basic test is that your QOF up on top. And just think of that really, it's kind of like your bank account or a holding company. It really doesn't do a whole lot, typically. And so 90%, every 6 months, 90% of its assets has to be qualified opportunity zone business property. And so that would include, it would include your investment in the QOZB. That would, any money that's in that, as long as the QOZB is qualified, that all counts. And then you could have, say, 10% sitting in cash. Or Bitcoin or whatever you want. You can have 10% bad assets. Now, it gets more interesting when you get down to the QOZB. The rules are much more liberal, and you can have 30% what we refer to as bad assets or non-qualifying property. So you generally have to have a business purpose to back it up, but you could have a 70% project, let's say real estate project, sitting in an economically challenged area, and then let's not cut it too close, but let's say 25% could be a small development in Beverly Hills, and you could both of those after 10 years could end up being both tax exempt on the appreciation. So it's highly flexible, but you do have to monitor this every 6 months.
So the testing is done by the IRS, and then is that correct?
The beauty of the program is most of the rules, including the initial qualification, are all done by the fund, and so it's kind of a self-policing process. And the IRS obviously has the right to come in and confirm your compliance with the all these rules, and there's a whole bunch of them. There's 980 pages of regulations, so it's not a simple process, but it's interesting. You file a form and basically confirm that you're in compliance, but they have the right to come in and audit that, and they will.
Interesting. So there's no independent verification of it. It's really a self attestation.
That's correct.
Well, I can understand why, given all of these complications, there's much more of an interest probably in for the average investor in trying to get into an opportunity zone fund rather than sometimes than trying to set up their own. Do you also help the people that you work with get investors for their individual opportunity zone funds or opportunity zone businesses?
That's not a big role we play, just because we want to stay independent, and we have so many of these. We're very busy just forming them, structuring them. There's a lot of time that goes into that. But there are, I mean, we run into some extremely interesting projects, and so we'll definitely flag those for there's certainly a percentage of our clients that say, hey, when you see something interesting, run it by me. And so we do certainly share some of the investment opportunities with our client base.
Are you seeing more of an interest in opportunity zones in urban areas? I know one of the criticisms of the program has been that there are those 8,700 zones all across the country, but that there's been sort of an outsized interest in places like Portland, Oregon, or other cities that have a lot of zones that are much more investable. That maybe it's not getting to the rural areas as much.
Yeah, I think that's still the case. Most people want to do projects kind of in their backyard, and so a lot of our clients are in you know big urban areas. And so you definitely, probably 80+% is going into the cities. And this one hasn't taken off, but I've been contacted by a couple of ventures that are, consolidating farmland. It's interesting because the way census tracts are drawn, in an urban area, it's a very tight, multi-block area. In a undeveloped area, it could be many, many square miles of space. So, there's definitely some people out there that are capitalizing on the less developed areas, but that's going to be a little slower process. But I probably get 2 calls a week from areas that are way off the beaten path.
Interesting. Yeah, I've heard a little bit about farmland opportunity zone projects, and part of the problem there is it's very hard to do that doubling of the cost basis as well.
Right. But although if it's undeveloped land, doesn't have structures on it, then there's really not. If you just buy raw land, there's not a specific improvement requirement. There's an implicit requirement because you can't just leave it as farmland, but you'd have to put some structure on it at some point. But there's no magical doubling of basis because there's nothing there yet.
Ah, good clarification. Great. Well, this is a great place to take a short break.
Like what you're hearing? Get more real estate investing news and advice from Millionacres on Instagram at Millionacres and on Twitter at Millionacres_co.
During our break today, we are excited to have Millionacres lead investment analyst Matt Argersinger here to speak briefly about one of our newest services, Real Estate Winners. Thank you for joining us, Matt.
Thanks for having me.
So, what is Real Estate Winners and who is it for?
Well, I like to think of Real Estate Winners as our answer to Stock Advisor in the real estate market. It is a service that provides recommendations on publicly traded real estate investment trusts and real estate companies. So it's a pretty big universe out there. There's over 200 REITs to choose from, and probably dozens, if not hundreds, of real estate companies are in our universe. And we provide regular investment recommendations as well as commentary on the market, educational material. And it's really designed to get anyone who's interested in investing and learning about real estate started.
So is it geared toward new investors or is it more for seasoned pros?
I think Real Estate Winners can serve both. I think if you're a new investor, maybe you're just getting started with stocks and you want to learn more about how to add real estate to your portfolio, great place to start. If you're a seasoned investor and just thinking, okay, how can I diversify my portfolio, maybe reduce the volatility in my portfolio, maybe add some income to my portfolio, then I think Real Estate Winners is a great solution for that cohort as well.
Fantastic. What are the benefits of being a member of Real Estate Winners?
Number one benefit is day one when you join, you get our top 10 investment ideas at the moment. So really right from the beginning, you know what our 10 best ideas in the publicly traded real estate market are. And then going forward on a monthly basis, you'll get a new recommendation, sometimes more than one new recommendation, as well as regular content that we're coming out. We're covering our past recommendations, providing updates, and talking about the real estate market. So it's really the full package.
Perfect. So what do you need to get started?
Really all you need is a discount brokerage account. So if you're used to buying stocks, and you probably already have that. If you haven't bought stocks in the past, of course, just open a discount brokerage account. These days, you don't even have to pay commissions. It's fantastic. So it really couldn't be easier to get started investing with Real Estate Winners.
Sounds fantastic. So how can people sign up?
Sure. They can head over to real.fool.com. That's REAL.fool.com.
Great. Thank you so much, Matt. I'm back with Blake Christian, a CPA and an expert on tax incentives. And in the first half of the show, we talked a lot about opportunity zones and why they're really exciting. But I know that there are also a whole bunch of other tax incentives to incentivize development. So what are some of those?
It's referred to as twinning in the opportunity zone and just tax jargon, and that means bringing two different code sections, two or more, together. And one of the beauties of the Opportunity Zone program is you can couple other tax provisions. So the New Markets Tax Credit program, which is more of a debt-based credit that over on the project, You can couple that with an opportunity zone project, and an opportunity zone project, as we talked in the first half, is really an equity based incentive. So it's kind of nice that you get both pieces of the capital stack, get some incentive. So there's a lot of people that are working together on the new markets tax credit. Now, on the Consolidated Appropriations Act that passed at year end, they extended that program for another 5 years, and so that renewed interest in that whole program and merging it in with an opportunity zone project. The other one, housing obviously is a massive, and especially affordable housing is a massive problem throughout the U.S. And so a lot of people are using those, and you get a lot of states and cities they may layer some other tax benefits in there, property tax exemptions, etc., to make the economics work. Um, so those are probably two of the biggest ones that are natural, you know programs to marry up with an opportunity zone project. And then just not a specific program, but just the depreciation rules that we touched on in the first session. That is very, very useful for big capital projects. And the other thing that we're starting to see too is city, government agencies partnering with with private industry to do public-private partnerships using Oz. And I haven't seen a whole lot from the Biden administration yet, but I do foresee, knowing what I know about his administration, I think we'll see the Oz projects used for infrastructure projects, because you're in the program for 10 years, so larger scale projects are perfect for this.
That makes sense because we've definitely got an infrastructure problem in this country. And the other thing that I know the Biden administration has been focusing a lot on is affordable housing and workforce housing. I think we're just seeing the start of that. Are you seeing developers get more interested in that and starting to think about how they can provide workforce housing?
Yes, I'm working on a few workforce housing projects, and in fact, I have a business that we convert shipping containers into housing, and we are in the final stages of putting that into an opportunity zone fund. But there's I live in Park City, Utah, and so we have a huge seasonal housing uh, problem because we have about 3,000 workers come to town to work, the ski resorts, and there's no place for them to stay. And so, but it's hard to get developers to build projects that are only going to be used for 5 or 6 months of the year. So it's a constant problem anywhere you live. That's probably the biggest issue. So, but we're seeing, again, we're seeing Oz be a partial solution for that. We're definitely working with a lot of government agencies and things on those projects.
That's fascinating about the shipping containers. I've heard in I believe it was in Aspen they were trying to do tiny houses and things like that for those seasonal workers because Park City and Aspen are these markets where rentals are astronomical, and then but you have all these workers who working in the restaurants, working at on the mountain, and and need a place to stay that's affordable.
The shipping container concept, number one, it's ultra green, and the portability of those can be moved in the off season. It's not super cheap to do that, but you can move them around. You could build a little community of these, and then when permanent housing comes in, you can move those and repurpose them somewhere else.
Well, you mentioned green, and that's something else I'm wondering about is tax incentives for green investing, responses to climate change. I know it's a major focus for the new administration. Do you think we're going to see more tax incentives around that?
Yeah, and actually, again, part of the Consolidated Appropriations Act, which passed right at year end, they kind of beat the Biden administration to the punch. But I'm sure we'll see more out of his tax policies. But they extended the solar credits for a couple of years, so that we're at the full 26% um, credit rate, which is fantastic. And as I said, wrapping that in an Oz fund really makes it pop the internal rate of return on these projects. And you only have to reduce your depreciable basis by 50% of the credit you claimed, which is a little unusual. So that got extended for a couple of years, the full 26%. There's a whole variety of other alternative energy credits that got extended, and I'm confident we're going to see much more of that. Again, that was under a Trump administration, and so Biden is you know green on steroids. So I think we'll see a whole lot more out of his tax policies real quick.
Well, I think that's really interesting too, because you mentioned before that you can sort of layer in these different types of incentives. And I feel like maybe some developers aren't fully aware of all of the different types of incentives that you can combine if you're putting green features like, solar panels or, gray water recycling. And if you're doing workforce housing or affordable housing. There are a lot of different incentives that you can do together. So one of the questions I wanted to ask, I know that you live in Park City, but you also have offices in California. What are you seeing from California? I know they've kind of been the leader in some of these tax incentives. Is Gavin Newsom going to come out with some more incentives?
Well, we hope so. The legislature there isn't, they're not real keen as other states are on certain incentives. Green, yes. Affordable housing, yes. But beyond that, not so much. And so, and Gavin Newsom has, for the last couple of years, expressed a desire to have some very limited conformity on the Oz program, and it would only be though for alternative energy production, and it's narrower than just throwing solar panels on, and then also for low income housing, that those projects would be allowed to be under the Oz program, but everything else is not. Um, I'm on an Oz panel there in California, so we actually have a letter going out next week that'll stress some of these others, but I can't talk about the details on that yet.
Okay, that does make me wonder. Are there those types of panels across all different states? Is that something that happens? Is that different people that are involved in these programs are constantly making changes or asking for changes as these different programs go along?
Absolutely. There's, every state has, an advocacy group made up of opportunity zone professionals, and and frankly, we've got, thankfully we have Tim Scott in South Carolina, who's been the co-author of the program, and with Cory Booker, and he has been just an unbelievable champion. But I will tell you that I think both his office as well as Congress in general are probably have a little bit of Oz fatigue. I have to admit they've been tremendously, from the regulations to notices, COVID relief. They've been tremendously taxpayer friendly on this program, like no other program. So, but that's what we're hearing is, look, don't ask us for anything else. We've given you every benefit. So I think it's going to be a little. I'm not expecting large taxpayer friendly expansions more than we have right now, and we are going to see probably absolutely we're going to see some changes like more disclosure, in tax returns as to what your projects are doing and stuff. And for the most part, the industry applauds that. That's fine. We're not fighting that.
Well, you mentioned COVID. I don't think we can ever I can't talk to anybody without asking about COVID impact. My impression was that COVID-19 had sort of slowed certainly some of the interest in opportunity zones and perhaps some of the investing as well. Is that something that you saw?
Oh, absolutely. I mean, I've got 3 clients with projects over in Hawaii, and but they don't live there, and so they, just flying back and forth, is very difficult, and or certainly during the early stages. So they couldn't even look for land. They couldn't, meet with zoning people. And so that 12-month extension that we talked about in the first segment, was much needed to give you more time to double your basis in a project that you're working on. So absolutely. And then the operating business is same thing. It's just slowed the process.
As we wrap up, I wanted to talk a little bit about the criticism around opportunity zones. I mentioned it briefly before, but there really is there's a little bit of there's been some negative media around it. There have been some of the advocacy groups for low income housing and things like that have criticized the programs. I know President Biden has mentioned it too. Is that something that you're worried about? And what is your response to that? Because I know you're obviously an advocate for the program.
Yeah, and I will absolutely, does Palo Alto, California need a opportunity zone census tracts? Probably not. But each governor was allowed to pick from a larger group and say, that's strategically a better census tract than others. So have there been abuses? Yes, but very limited. And the fix is going to be, from what I'm hearing from Washington, is that they will grandfather those census tracts that have already been identified. So if you have a project going there, you're okay. But if you haven't started a project there, because of the 2020 census, the census tracts are going to get redesigned a little bit anyway. And once that happens, they'll grandfather those old ones, but they're going to probably eliminate some of those, like Palo Alto, and say, hey, you can't be a qualified census tract for any new projects, and they'll replace it with with another one. So they'll fine tune that. The press, individuals that are looking for examples of problems, you're always going to be able to find an exception. But I can tell you, because I work in this area every day, I'm just not seeing abuse in here, and I think the naysayers that say, "Oh, this is going to be a big flop," 10 years down the road, I think they'll be eating their words. I think this is going to be a very, very good model for the long term.
Well, that kind of tees me up perfectly for my last question, which is looking ahead 10 years. I mean, certainly there are going to be some changes to the opportunity zone designations. There have been little tweaks to the program all along. So what is your hope for the future of this? Do you feel like there's going to be an overhaul of the program at some point, or do you think we're going to continue to see just a refining process?
I think it's going to be refining, and I think I'm hopeful. In some states like Ohio, they've been trendsetters and layered in other state incentives, like an extra 5% credit for doing this, or layering in hiring credits for employees that get hired in these opportunity zones. That, I think, is going to be the trend. And as I mentioned earlier, I think using it for infrastructure project, more public-private partnership arrangements. I think that's the real power of these. Hasn't been fully released, and there's a lot of innovative people out there that are starting to see the light. It took 2 years to get all the regulations out, so we've really only been operating for a year with perfect clarity on how all the rules work. And I think the best is yet to come. The final thing I'll say is this program actually goes out to 4046. Okay, now you can only defer your gain and things up till 2026, and we think they'll extend that. But you can hold on to a project till 2046 and let that appreciation all build up tax free. And that's where my really smart clients are saying, hey, I don't want to sell after 10 years. I want to just let this thing appreciate, and then sell it, and it's all tax free. I mean, because you sell it in year 10 or 11, and then what are you going to do with the money? Invest it in a taxable investment. This is tax free forever.
Well, I had one more question on that, actually, since you talked about that. Is I know in the beginning of the program, there was the 15% step-up basis, and it's now a 10% step-up basis. Do you think there's going to be a return of that 15%? Does Full Opportunity Zone sort of reset at any point?
Yeah, there's a very good chance. There's a lot of talk on both sides of the aisle right now, and I was on the phone a couple of weeks ago with one of Senator Scott's legislative assistants, and so they're pushing to delay the deferred recognition date till December 31st, 2028. There was an effort a year ago to push it out to 2030, but I think 2028 honestly is reasonable because of COVID. We definitely have a 2-year impact minimum on this. So if they push it out that far, then that essentially refreshes the 7-year hold by the time you get to 2028, as long as you make your investment by the end of this year. So I think there's about a 70% chance that will get through, and then we'll be back to a 15% basis bump instead of just the current 10%. So excellent question.
That would be an incentive for a lot of people. I know that would be very interesting and would probably bring more people back into the program.
Absolutely.
Well, this was really fascinating. Thank you so much for your time. Just a reminder for our listeners, I was talking with Blake Christian. You can learn more about his work at hcvt.com. Stay well and stay invested.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. If you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discuss that Millionacres or the Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.